Thanks everybody for joining us for the Total Return webcast here, June 11th, 2024. I say this every year, but it's hard to believe that we're barreling towards the middle of the year already. And the summer always goes very, very quickly. The title of this webcast, as you can see on the screen, is 1968. And I'm thinking about the political environment today and a lot of the growing tensions around the world and the multiplication of tensions. The picture on the screen is of Columbia University on April 23rd of 1968, where 5 buildings were taken over by students, and they actually kidnapped a dean for a brief period of time. And about a week went on, and then they had to order in 1,000 police to clean up the mess, and there were over 700 students arrested. But that was just one example of all of the protests, which were not confined to the United States or to the universities. They were all around the world. There were massive strikes in Europe, anti-Vietnam War protests in the UK, and then all across America with the 1968 election. Interestingly, the year 1968 began with the first day of the year. The New York Times had their headline, "World Bids Adieu to a Violent Year." So people were happy that 1967 was gone. But as so often happens, you don't really know when it's over, and oftentimes what you thought was bad is followed by something of the same ilk, but much more severely. So I'm going to go through a timeline of 1968. I lived through it. I was in 3rd grade in 1968, and I remember being aware for the first time of anxiety about the situation, and the world didn't seem so safe. But the year started out in a pretty good spot. January 22nd of 1968 was the debut of Rowan and Martin's Laugh-In, which was about the #1 show in America. It was on once a week, and celebrities would go on, and it was kind of a skit type of a thing, kind of a precursor to Saturday Night Live. And it was called Laugh-In as a play on all that was going on with sit-ins and be-ins and love-ins, or all these ins. And so they said, let's have a laugh-in. So let's leave the cares of the world outside for an hour, and Rowan Martin's Laugh-In. But things started to deteriorate pretty quickly. January 23rd, just a day later, North Korea seized the USS Pueblo, claiming that the surveillance ship strayed into North Korean waters. A crewman was killed, 82 were imprisoned, and an 11-month standoff between the US and North Korea ensued. And then January 30th, North Vietnam launched its Tet Offensive, directly contradicting LBJ's claims, the President of the United States, that the communist forces in Vietnam were weak and that the US was winning. That was a complete lie. And it was later shown so in the Pentagon Papers, which were published finally in 1971. February 1st, 2 Memphis sanitation workers got crushed to death by a malfunctioning garbage truck, leading to strikes that turned into the Civil War movement. Largely was born in its last phases of violence on that date. And then February 7th, after a battle in Ben Tre Village in Vietnam, an American officer told the Associated Press, quote, "It became necessary to destroy the town in order to save it." And that became a huge anti-war rallying cry. Kind of reminds me of Nancy Pelosi saying that we have to pass the healthcare bill so we can figure out what's in it. And then February 27th, the most trusted and revered TV news anchor, Walter Cronkite, did a tour in Vietnam, and he came back and he said, the situation is mired in a stalemate, which directly, again, contradicted the administration's claims that the United States was on a path to victory, and it greatly swayed public opinion against the war. So things started to accelerate. On March 12th, the New Hampshire GOP primary and Democratic primary were held. Nixon won the Democratic primary with 78% of the vote, but Eugene McCarthy, opposing LBJ as an anti-war candidate, won a shocking 42% of the Democratic vote. So that on the basis of Johnson's poor primary showing, just 4 days later, New York Senator Robert F. Kennedy entered the Democratic race. And then 15 days later, LBJ, who had won the 1964 election, 61% of the popular vote, announced that he was not going to run for re-election in 1968. Then all hell broke loose. April 4th, Martin Luther King, who was in Memphis Jr., Martin Luther King Jr. in Memphis for the sanitation worker strike that was started earlier that year, was fatally shot. And riots erupted in over 100 US cities, leaving 39 dead, over 2,600 injured, and over 21,000 arrested. There's a good website about 1968 with pictures from Atlantic magazine that goes through, and the images are really worth looking at because things were pretty out of hand. And then on May 27th, the Supreme Court ruled 7-1 that burning a draft card would not be excused as a protest of based upon free speech, so you couldn't burn your draft card. Then June 3rd, a little off topic, Andy Warhol was shot by somebody who was in his circle, and she was mad that he had lost a copy of a play she wrote or something like that. But then a day later, June 4th, more killings. RFK wins the California primary by a lot, and that night was assassinated at the Ambassador Hotel in Los Angeles. So June 19th, 50,000 people joined a rally on the National Mall to protest the state of affairs in the United States, the racism and the poverty of the underclasses. So this all culminated in the Democratic National Convention, August 28th, DNC in Chicago, where the police and the National Guard went on a rampage, clubbing and tear gassing hundreds of anti-war protesters. And isn't it interesting that the Democratic National Convention this August, I believe it is going to be in Chicago also. So some parallelism there. So September 16th, trying to get rid of his sourpuss image, Richard Nixon, running for president, went on Laugh-In and said 4 words. Celebrities would go on Laugh-In, and I don't know why they thought it was funny. They would say, "Sock it to me." And then November 5th, Nixon won barely in the popular vote, but Shirley Chisholm also set a landmark, being the first Black woman elected to the House of Representatives. And then finally, December 23rd, North Korea released that Pueblo ship that they had said they'd confiscated, and they released the crew, but they kept the ship. And it's still there in North Korea. The ship, the USS Pueblo, is on display in what's called the Victorious Fatherland Liberation War Museum in Pyongyang. So with that as a backdrop, let's get started. This is new homes under construction. I'm breaking it into single family, which is the gray area, and the orange area is multifamily. And I'm pointing out that there's a parallelism here between the late 60s, or at least around 1968, maybe 1970, where we had a very high percentage of multifamily units under construction relative to single family homes. And it was a ratio that hasn't been seen until today. And I find this interesting because that was the baby boomers back there in 70, 74 that caused that thing. And now the baby boomers are the ones that are being protested against. The baby boomers protested against their parents and their parents' policies. But now it's the younger generation is protesting against their grandparents, those very baby boomers. And so we now also have a lopsided total multifamily home versus single family home construction. That probably has something to do with how unaffordable the mortgage payment is as a percentage of household income. You can see that back in 2018, 2019, it was around 20% or even lower with the 20% down payment, a 30-year term, and the median existing home sale price. That has gone from the high teens percentage of disposable income, of household income, to 30%. So no wonder people aren't feeling happy. They've lost 10% of their disposable income has now being funneled into just a median standard mortgage payment. And of course, home sales are very, very low. In fact, this goes all the way back to 2001. And we can see that the most recent print is the absolute lowest that we've seen over this 23-year span of time. So we've had low unemployment. We use the establishment survey for unemployment. It comes out the first Friday of every month. And this exhibit shows the number of consecutive months that the U.S. unemployment rate was beneath 4% from the first month that it went below 4%. And we've actually back to the 1968 period where we've had 27 consecutive months. The last one was 3.96, so it's still below 4. But that makes it actually 1 month longer because we would tack that one onto this series. So we're in the same type of extended low unemployment situation going back all the way to the late 1960s. We look at unemployment as a very important indicator of whether we might be at the threshold of a recession. And one thing we use as a yellow flashing light is the unemployment rate versus its 12-month moving average, which is on the screen now. And indeed, we are slightly above the 12-month moving average. And once you get above the 12-month moving average, you really have a yellow light for a recession. It really looks to me like the trend has changed here. We've actually been in a gently increasing unemployment rate on the U3 for basically a year and a half. And a lot of things have been in place now for about a year and a half, and we'll explore that presently. But first, let's go to the red light indicator, which is the U3 unemployment rate versus its 36-month moving average. And it hasn't gone above yet, but that gap has closed a lot, and we'll see what happens in the next unemployment report. If it goes above, that would be a warning sign for a continued economic slowdown, which has started to occur, and we'll get to that in a moment. Here's a thought experiment we've shown many times in the past. We just take the middle two quartiles of past recessions, and that's the shaded blue area, and then we take the median of all the recessions over this period, and we'll see that we live within the blue shaded area. We've got the red area is the current movement in the U3 unemployment rate. I'm just pointing out that it does look that it's following that median trajectory. So I'm not really willing to declare that this is crossed the line yet, but things are starting to fall into place. Also, payroll revisions are acting awfully strange. In fact, payroll numbers have joined the inflation numbers as being a little bit difficult to understand, because the most recent jobs report had, on the establishment survey, had 272 jobs added, which was a good number. However, that same day, there's the household survey, which at turning points in the economy has historically been a better indicator. And that showed a very different situation. It did show job growth, but while the establishment survey showed full-time jobs going up nicely, and we'll see that in the next exhibit, the household survey, last report, showed that full-time jobs lost 625,000 jobs. So one report says there's hundreds of thousands of jobs gained, and the other one shows hundreds of thousands of jobs lost. In addition, what we've seen, and I don't have this exhibited in this deck, but we've seen government has been growing again, and government payrolls are not really very productive. And in fact, they might even be intentionally accelerated in order to make economic releases look perhaps a little bit rosier. But one thing that happens in the establishment survey is there's a number that's initially released. It gets tremendous attention every first Friday of the month. And then after a while, they finally stop revising it. And this is the history of the difference between the first release on the first Friday and the final value after revisions. And you'll notice that the revisions now for about 18 months, again, a lot of things seem to have been stabilizing over the last 18 months. We see that we've had basically every month nearly has had a revision that came in lower than the first stated number. And the reason for that is that the establishment survey uses the birth-death model to estimate things. And it seems to be anachronistic, and it seems to be leading to overstating the initial number and then having to revise it lower. Also, things worth looking at, the employment picture. This is unemployed part-time for economic reasons, which means they want to work full-time, but they can't find a full-time job. This also looks like it turned up. Not alarmingly yet anyway, but over the last 18 months. So that one, this is some leading indicators for potential unemployment or employment changes in trend. And we see that the red line is the U3 unemployment rate. We've inverted it here, so it's the same as we had in prior exhibits, but now it going down means that unemployment rate is going up. And then we see a leading indicator, which is small business hiring plans index, which tends to go sharply to the weak side before the unemployment rate starts to rise. And it's one of the more extreme declines in the small business hiring plans index without having really that definitive of a rise in unemployment. So we're going to be watching for this in the next reports. Also, average hourly earnings in manufacturing. Manufacturing's been quite weak. It's been one of the weaker parts of the economy, so we have to take this with a grain of salt. But nonetheless, the average weekly hours worked are definitely shrinking, and they're shrinking at that pace, which has been consistent with recession. So all these things are kind of on the brink, but it's too early to declare that we crossed the line. I always talk about the budget deficit. I'm going to spend very little time on that in this webcast. We have a 5.7% GDP unemployment rate without a high unemployment rate or anything like that. And the Biden administration has forecast that next fiscal year will be 6.1% of GDP. And of course, this is getting a lot of attention because people are aware of the things we've been warning of and monitoring closely, like the interest on the debt, which is now basically the same as the defense plus war budget. It's actually bigger than the official defense budget, but if you throw in the money for the wars in Israel and Gaza and Ukraine and Russia, we're now up at 861 trillion on, it's hard to keep track, 861 billion on the debt, and then we've got 895 on the war machine. Social Security and Medicaid are still bigger, but we can say that the federal interest expense as a percentage of federal revenue under the current tax system is alarmingly increasing. And it's basically, it's well above where it was in 1968, even though we were in the middle of the Vietnam War, which was a much more hot war than the ones that we're proxying right now. But it was at 7%, we're now more than double that. So the interest expense as a percent of federal ratio is twice as bad as it was in the tumultuous year of 1968. And of course, the interest rate on the Treasury debt is going up because we have the stuff that was floated at 25 to 100 to 150 basis point coupons during pre-pandemic. Now those are being replaced with, well, the 10-year Treasury was at 447 yesterday. And so it's down a little bit today, but it's quite a bit above the 333, which is the moving average of the yield on the outstanding Treasury debt. It's obviously going to go higher if rates stay at these levels. There'll be some bonds that would be floated that were, say, they were issued for 5 years in 2019. They had a 25 basis point or 50 basis point coupon. That's going to go up by 400 basis points. So this problem is going to get worse. And that's all I'm going to say about this. Now, people are talking about consecutive weeks of inversion, and they point out that going back to the late 70s, we see that we now have the longest period of 2s10s reversion of any length of time. But I want to caveat this because although this is a lengthy one, look back at the left side of the exhibit from 78 into 82. I lived through that time period. And I can tell you, it never felt like you were out of recession from 1978 into late 1981. People don't remember that when Reagan came in, the economy actually got bad again. You'll notice that blue area that was prior to the recession of inversion, that there was a small hiatus when it was de-inverted. But if you used more of a moving average thing, if you take my point of view that this whole time period was really one 4-year-long or 3-year-long recession, actually, you would say that the curve was inverted back in the late 70s, early 80s for more like not just 100 weeks, but more like 180 weeks. So we haven't really broken that record going back to the 1980s, but certainly it's been inverted much longer than most periods of time. And people ask this question, I saw it in the queue already. Why is that? Why are these recession indicators not working? And the answer, I think, is pretty clearly that we've had high volatility of economic response, both fiscal and monetary, highly volatile. We took rates down to zero. Some countries went negative. We had tremendous amount of money printing, and then the Fed embarked on a 525 basis point Fed funds increase, and we're still debating whether that's going to stay at that level for much longer. We know we have the Fed tomorrow. We also have the CPI tomorrow, which is an interesting combination. So it's going to be very important to see what happens to the summary of economic projections that comes out every quarter. And here it is June, so it comes out the third month of every quarter, and we'll look very carefully at how the market reacts. My prediction is that the Fed will no longer show 3 cuts this year in their work tomorrow. I think they're going to say 2 cuts. I think if they stayed with 3 cuts, I think you would get a rally in the short end of the bond market, and you would get a sell-off in the long end. We have some de-inversioning going on, but I really think 2 is the number. And I think if they do say it's only 1 cut, I think you're going to see repricings to markets that are more hawkish in nature. So let's look at the yield curve steepening before the recession indicator. And yeah, it's been deeply inverted. It's been a long time, but again, it looks kind of like the late 70s, early 1980s. And we're going to be waiting for this thing to go above zero before we really say this indicator is a real red light caution for the market. A lot of people are focusing on the fact that it's been averted a long time and there's no recession, but if you look at this chart carefully, you want to see it go above zero to really ring the bell in a loud way. Here's consumer confidence, less present situation, same sort of a thing. It hangs out where their view of the future is bleak compared to their view of the present. That's when the gray shaded areas get very big. But it's really when it goes sharply the other way that you are worried about recession. We're not there yet. So again, we've got the setup, the conditions are in place, but the catalyst has not yet appeared. But things have slowed down. I talked about the last 18 months, but look at just, now this is a very short-term time period. So one has to be careful. You can't make decisions based upon just short-term data, but this short-term data is kind of remarkable. The blue bars are the NBER monthly recession indicators, and they're labeled down on the x-axis. And it's the 3-month number annualized. And most of them were decent or very, very good. It was the manufacturing, which we've been talking about for a couple of years, has really been a bad part of the economy because it was overheated thanks to all the government money printing. But just look at the last month. Again, let's not make too much out of a month, but they really have reverted from the 3-month annualized. Virtually, they're all zero. In fact, the only one that's even positive is non-farm payrolls for May. And we'll see what happens to the revisions there because we have very inconsistent data from the household survey and the establishment survey in the most recent prints. Here's small business optimism, which is probably the weakest part of the economy. You can't really be surprised. A lot of small businesses have gone out of business because they couldn't make it through the lockdown period. And it doesn't seem like their mood has improved at all from that horrible experience in 2020, 2021, where so many businesses shut down. Here's the Bloomberg U.S. Economic Surprise Index. The categories are up on top, and I'll just point out that it was surprising pretty decently until the last couple of months. So again, another harbinger perhaps that maybe something has changed. We need more data, and I'm sure the Fed will comment to the fact that they're data dependent, and I'm sure they will acknowledge some of the slowdown that is in some of these numbers, but it's not enough to be convincing because of the time frame. So here's what's happened to the market's view of the Fed funds, what it's pricing in. It's pretty interesting. As of April of 2024, you could see what was being priced in, and they see June, and then we see the other months, and we can say that it's really changed. When we were earlier in the year, January 2024, that's the green line. The market was almost crazily looking for about 7 rate cuts. And that disappeared pretty quickly when the first quarter data, and particularly the inflation data, spiked up, which happens seasonally. We're going to get to this. So we're not as alarmed, I think, as the market was at the end in March and April. But we see the big repricing because when you just got to April, the red line, you're down to just a cut or two. And that seems to be pretty much where we are right now as of June 3rd. It's a little bit more, but it's really only about 1 or 1.5 cuts for the year. I still believe the Fed will talk about 2 cuts in their SEP dots. Here's the 2-year Treasury, which does lead the Fed funds rate. I get pushback on this a lot, but I actually did calculated. Of the last 11 times that we had the curve change direction, the 2s, 10s, the Fed changed direction in their Fed funds rate policy. Of the last 11 times, 9 of them, the Fed was led by the change in direction of the 2-year. 1 of them, the Fed was in front, and 1 of them was simultaneous. I would say the one at the most leftmost yellow circle is simultaneous, but clearly they're largely in front of the Fed changing policy. Right now, this indicator would say the Fed is going to be cutting rates sooner rather than later, and I suspect the Fed will say something at least in line with that, not contradictory to that. This is an interesting thing that when I showed about the unemployment rate leading into recession, this is the change in the 2-year Treasury yield around the last Fed rate hike. And this one is not anything like the median of the last several observations of the 2s, 10s twos, tens, and the Fed hike. What we see here is, if anything, this suggests the Fed might stay on hold a little bit longer, which would come as a surprise and would not be a welcome development for the market's sentiment. And also, here's the 10-year Treasury around the last Fed hike, and that too is not really following the pattern of past activities. I just point that out because this has had a very different look over the past few months than it did, say, in the fourth quarter of last year. Here's something that's just amazing to me. This is the U.S. When you compare tips to nominal treasuries, you get an implied inflation break even. And it really is interesting that while there was some volatility on the 2-year and the 5-year, the 10s and the 30s, the purple line and the blue line, have been remarkably stable. So I think one of the things that is a challenge for the market, or could be a surprise for the market and the disruptors, what if this changes? What if the attitude of the pricing in the bond market breaks out of this incredibly stable range? I'd call this almost of the ilk of the Byron Wien, surprises, 10 surprises or however many it was at the end of every year. Because if this actually changed, I think it would be a real game changer for markets. Not happening yet. What else is interesting in terms of how it's changed? Well, how about the 12-month rate of change of central bank policy rates? You'll notice that back in around 1968, 1970s, you see that there was tremendous volatility. Month-over-month changes in policy rates, 12-month changes in policy rates were flopping around. And then, of course, we went into financial suppression or repression back in the aftermath of the global financial crisis and the problems in Europe. And you had almost no changes for a very long period of time, longer than anybody's career experience ever saw before. And now we're going back into a little bit more volatility. So it would seem that the template of 2011 to 2019 is probably not going to be very helpful in thinking about risks in markets going forward. Another question, that question, why is there no recession? M2 went negative year over year. Why no recession? Well, this is, I think, what monetarist economists failed to fully appreciate, is that the yellow dotted line is the trend pre-pandemic of M2 money supply growth. And we see that it totally blew out away from that trend because of all of the money that was printed by the COVID response. And while M2 did go negative on a year-over-year basis, you see that blue line started to move down. You'll notice that it's still pretty close as of April 30th. It's still pretty far above, rather, the trend of pre-pandemic. So I get a lot of, I notice a lot of commentators talk about excess savings has dried up. Maybe that's true, but this suggests to me that the economy has been powered along by tremendous, pig in the python of money supply growth back in the pandemic. But money supply growth was negative, not by a lot. You see that huge growth. This is just year over year M2 money supply growth, and it did go zero. And this is why I think a lot of economists that are particularly monetarily oriented, and I certainly respect the M2 going negative, and so I probably gave this too much emphasis as well. But we see that it's now actually positive, 0.6 on the M2. All right, let's look at some other areas. We're going to spend quite a bit of time on inflation, which I think is important. And here, this is wage growth and the quits rate. The Atlanta Fed wage growth tracker is now it's been suspended. So it's at 4.7. So I'm just really looking at the quits rate. But the fit between wage growth and the quits rate is pretty tight, as your eye can see. And this does suggest that the wage growth tracker, if it becomes republished, should probably start moving down, although it's still uncomfortably high for the Fed at probably 4.5% now if they come out and reprint it. Commodity prices have potentially bottomed out. Gold remains very elevated, having a great year. I was bullish on gold entering the year, but I didn't expect to go up 20% that quickly. But it's holding that gain awfully well. But commodities are really all over the place year to date here in 2024, with gold up a lot. Copper's been all over the place. And what we see is some commodities are down a lot and some are up a lot. So there's no general commodity trend. But we're putting it all together here with the BCOM index. And the red dots, that's the 200-day moving average. And I'd been sort of bearish on commodities since 2022 in the summer. And they couldn't get out of their own way. But it seems to me that the commodity complex may be bottoming. It did break down below the 200-day moving average briefly, but as of yesterday, it was slightly above the 200-day moving average. And so be watching for this, because I think commodities may start to get into an interesting moment if the dollar starts to drop as a consequence of a recession developing, whenever that happens. Okay, let's look at inflation. Here's the most standard one. It's a CPI, year over year, comes out tomorrow. This is PPI, producer price indices. My apologies. The blue line is ex-food and energy, so-called core. The Fed can't be too happy that this has stalled out at around 3%, although it's way better than it was. And then you see the final demand, which is even less encouraging for the Fed. While it's at a better level at 2.2, it was down nearly at 0. So with commodity prices going up, I put these indices in this order intentionally. Commodities are the fastest, highest frequency, and we see that seems to me have bottomed out. And then PPI is the next highest frequency. It leads CPI, and it's a little bit discouraging that seems to maybe have bottomed out. And then we see the CPI, and we see that has stalled out at about 3.4 and 3.6 for the ex-food and energy. The prediction for tomorrow is that the headline CPI will be at around 3.5% year over year, so not much movement, and that maybe the ex-food and energy, the core, will be at about the same level. So the Fed really wants to see this go down, certainly into a 2-handle, and that's not going to happen with the print tomorrow. So it'd be interesting to see how the Fed wants to comment on that. One thing that's driving this inflation is kind of wacky. It's auto insurance inflation. I mean, if you drive a car, you probably know now that auto insurance is up a lot, but this is the actual data, and it's up 22.6% year over year. And this is contributing substantially to CPI. But will it go down? I don't know. It's been going up more than 5% for the past 3 years in a row. So if you think about the cumulative impact of this on the cost of auto insurance, it's pretty staggering. And remember, auto insurance is not something that you buy once. You buy it every day, because by law you have to own it in most places anyway. And so you're forced to participate in this program, and you're running into this double whammy for the insurance companies, where the frequency of problems has gone up with fewer insured motorists on the road. There's more uninsured motorists, so that increases the cost to those that buy insurance. Carjacking is up, auto theft is up, the cost of repairs is up. And so you've got the frequencies going up, and you've got the cost going up. And that's creating this incredible monster of an inflation contribution. But I doubt these prices will go down unless we go into a radically different state of society, which maybe will happen, as happened in the several years after 1968. Here's U.S. headline core PCE. That I put this one in. It's not the highest frequency, but it's the one the Fed leans on the most heavily. This one is the most encouraging for the Fed, remains the most encouraging. We see that the headline number is 2.7, and we see that the core number is 2.8. At least they're below 3, and at least, while it did tick up on the headline number, but while it's decelerating on the downside on the core number, it's somewhat in the comfort zone, I would think, for the Fed at this juncture. Now, what you don't hear about anymore is super core inflation. Remember that one back in 2022? They wanted to look at super core inflation, which is core services ex shelter, which ex housing, which turns into a very small piece of most people's spending. I mean, food, everybody; energy, everybody; housing, everybody. So there's maybe auto insurance isn't in this, but we see that supercore PCE has stalled out at 3.4, and so they don't want to talk about that. Let's just look at the regular PCE, because that's looking in the 2-handle. But look at the CPI. The supercore CPI is really disconcerting. It's 4.9. Now that does include auto insurance in there, so I think it does anyway. And so that's part of the reason for this divergence. but don't hear about that anymore. Here's the contributors to headline inflation. And you'll notice that core services is all of it here. I mean, you've got 3.4 year over year and PCE on the CPI. And we see that the gold area, core services, is just about everything. Contribution to core inflation, again, it's basically shelter and core services ex shelter. That's your entire inflation rate. There is no inflation in core goods. Core CPI ex shelter inflation, I put this in almost as a joke because you can get an inflation rate at any number that you want, just like it seems that you can get unemployment data that's greatly inconsistent, one series versus another. If you want to say that inflation is under control, then you can say, I'll do a magic trick. I do core CPI ex shelter. And there you have it. You've got 2.0-ish core CPI ex shelter, and you're not being terribly creative in how you're slicing and dicing the components. So shelter obviously is a big component of inflation, and it should come down. This has been a little bit disappointing for the Fed, I'm sure, because if you look at new tenant rent index, it's at 0.8% year over year. And yet the CPI shelter component is at 5.55 year over year. So there's a 475 basis point difference between the two. And shelter inflation is about a third of CPI. So you can dream that these things will converge. I do notice that there usually is a higher number on the shelter than the rent index. But if they converge by even 300 basis points, then you would knock something like 100 off of the CPI rate. And that's really the piece that's missing for the Fed. We need this to come down to offset auto insurance, believe it or not. And then here's something that's interesting. November 1st, we had that pivot, the rhetorical pivot by the Fed, where they got away from 12-month numbers and they started talking about 3-month numbers annualized and 6 months numbers annualized. Well, they're not talking about that anymore because on CPI, this 3-month annualized and 6-month annualized are both worse than the 12-month annualized. So that one's brushed under the carpet. We can do the same thing for PCE inflation, and we get nearly the same result. We get that the 12-month number is higher than the 3-month annualized, it's lower than 3-month annualized and 6-month annualized. So the trend here has not been good, particularly for core PCE, where the 3-month is worse than the 6-month is worse than the 9-month annualized. So here's something that's interesting, that we hear about this 2% inflation target that was developed quite a while ago. And we've got that 2% number on the lower exhibits. So that if you're running at exactly 2%, that would be the inflation trend line. And it's curious how we had headline CPI and core CPI, the blue lines, really tracking along. Particularly the core CPI was like glued to that trend line. And yet then the pandemic came, and of course the monetary response spiked inflation. And so now we're well above the 2% inflation target, not only for the last year or 5 years, but also the last 10 years. It's 3% for core CPI and 2.5% for core PCE. So it's just interesting how inflation accumulates. We've been doing a lot of work at DoubleLine, not just looking at headline numbers and not just looking at short-term fixed time periods, but trying to do a deep dive. And these are some of the things that we've uncovered. This is my favorite, as everybody knows, export and import prices, which are averaging zero. You've got import prices at 1.1 and export prices at negative 1.0. So they have been very tame for the past couple of years. And they were terrible back with all the supply chain shocks and everything. And then they relaxed, understandably. And now we're basically right back to where we were pre-pandemic, running at around zero on the growth in import-export prices. That's probably a good thing. If you're on food stamps, you're on a fixed income, then you've had a bad run here for the last 5 years, because the purchasing power of a fixed income deflating by PCE inflation, which isn't the highest inflation out there, you've lost 14% of your purchasing power. This is obviously, these are reasons why people are unhappy. They're not getting big increases, particularly if they're on entitlements or on food stamps, which is another entitlement, or they're on a fixed income as a retiree. You're not getting any growth there. and you've had a steep fall off in your purchasing power. But one thing that's interesting is the University of Michigan expected price change. It's a survey, and I'm skeptical of surveys, but this survey shows that forever, the median, the red line, has been at about 3%, plus or minus, 2.5 plus or minus, and right now it's at 3%. But we also looked at the mean, the average. You see, the mean has gone way up. So what this means is the median hasn't moved. So the dispersion around that median has not really moved has been relatively constant. But all of a sudden, one of the tails for higher inflation, those that think inflation is going to be higher in the next 5 to 10 years, well, that's gone off the charts. It was at 2.5, and now it's at 5. So what this means mathematically is that the people who are revising to the high side have a very wide tail, whereas the people that are at the below, calculating to the mean, they are probably more tightly clustered. Sort of interesting. We'll see what happens if this mean number moves. That's going to be just as important as policy rate volatility changing and other things that I talked about that have been slow to move. Here's some good news for inflation. Let's do some good news. They seasonally adjust the PCE, but they don't do a very good job of it. If you take a look at the median gap versus core PCE for the last 14 years, what you find is that they still seem to overstate first quarter inflation. First quarter inflation definitely comes out seasonally higher than other quarters. And the particularly good news is that in the second half of the year, it's actually the weakest. And you'll remember last year, we got to 7 rate cuts expected for 2024. That was kind of on the back of weak inflation in the second half of last year. And of course, we've had higher inflation for most of the first half of this year. But the good news is that might be relaxing. The other piece of good news, gasoline prices have been falling. WTI has been falling a little bit. So we see WTI, the blue line, was up at 85. It's now in the high 70s. And usually it leads, and gasoline may be falling. I suspect that there will be some attempts to weaken gasoline prices in front of the election as well. All right, so let's take a look at the bloodless verdict of the market through last Friday. The winner this year in the bond market, and this is just the U.S. bond market. We do have EM on here, but it's mostly U.S. We have triple B CMBS, the thing that everybody wanted to hate the most, is up by the most, and double B CLOs are up 11.2, and triple C loans have done really well. Defaults haven't really materialized, at least not yet, and people like the high coupon on this stuff, and so they're up nearly 10%, and then triple B CLOs also doing well, up 6%. So it's loans and CLOs and CMBS that are doing well, and then you get into high yield isn't doing particularly well. It's only up 2%, but at least it's up. When you get into EM, it's up 1.3. One thing you want to consider is Venezuela has made its way back into the emerging market bond index, and that has raised the yield of the index in a technical way. So EM spreads aren't really widening. It's that they've reintroduced Venezuela, which has increased the spread by at least 30 and maybe as much as 60 basis points just by including it. But then you get into investment grade stuff, and there's just no positive numbers here. Investment grade is down. AA is down almost 2% and so forth. The best thing here, again, is the lower credit. Triple B investment grade is very slightly down. So not a lot of return in the traditional higher rated bond markets. Copper gold ratio checking in, totally not working. It didn't work during the lockdown, and then miraculously it worked during 2022. The two lines converged. But ever since early 2023, not working. Copper gold ratio says rates should be substantially lower than where they are. And the divergence remains. I just have been using this for years. It doesn't always work, but it's been a good long-term indicator. What's been working better, frankly, than copper gold is just plain old simple WTI. The price of WTI and the generic 10-year bond yield are very highly correlated for pretty good reasons. And they've been particularly highly correlated for the past, I don't know, I'd say 8 years. So this is really worth watching. And we notice that crude oil has been sideways broadly for the past couple of years. Here's the 30-year Treasury bond. Always bring this up. It was in a long-term declining trend, broke out of that trend, and we're way out of that channel. In fact, we're out of it almost by a factor of 100%. And because of that, you see these horrific bond returns. You see the 30-year Treasury is still down 50% in price on this drawdown cycle going back to 2020. So this leads me to something I want to spend a little bit of time on, and that's the banking system. And I'm talking about the small banks, the ones like SVB and the ones that had problems in 2023. You'll see small bank deposits are now higher than their 2022 high. You see the 2023 problem was caused by that blue line coming down. But this is sort of a double-edged sword, because the reason their bank deposits are going up is they've had to increase what they're paying on them. So you have all of these deposits that are coming back in, but they're not paying zero on them anymore. And they still own a lot of securities that caused their problems back in 2023. So if we look at small banks' exposure to commercial real estate, okay, so I'm just saying that small banks' exposure to commercial real estate is increasing as a percentage of their assets. Part of that's the denominator effect, that the assets like the treasuries that I showed the drawdown on are way smaller, really, particularly the ones that they're marking to market, the ones that are so-called available for sale. But if you're worried about commercial real estate, this is okay. So this is sort of a warning sign. You see that their commercial real estate holdings have been increasing, although they're not that high. But here's the last thing I have on this, and this is FDIC insurance institutions and unrealized losses. And this is all FDIC insured institutions. And what you see here is there's a massive embedded loss in these investment securities. We see the held to maturity securities, which aren't even put through their financial statements. They have massive losses of hundreds of billions of dollars. And then the available for sale securities still have tremendous amount of embedded losses. You add it all up and you're at $700 billion of losses on investment securities, in spite of the fact that the bond market has somewhat improved. Here's credit card delinquencies, which I'm checking in on because they're now noticeably higher. This is from Deutsche Bank and Philly Fed and St. Louis Fed. They're noticeably higher than they were pre-pandemic and trending high very, very quickly. This is one of the reasons why I think we're starting to see some of the anxiety building in the economic system. This is CLO prices. We saw that CLOs have been doing very well. We actually have increased the very high rated, the safest of all AAAs, which are generating yields that are up near 6%, up near 7%, which is pretty attractive considering that we think they have no risk from default standpoint, and they float if you're worried about interest rate risk. So we can see that the prices just completely cratered in 2020, and then they made it back pretty quickly into 2021, then fell again and in 2022 with the bond market being weak. But we're all the way back up. If you take a look at the top rating categories, AAA down to BBB, they're all clustered together. They're all basically at issue price or par. For this reason, the CLO market is being refinanced at an epic rate to the extent that, amazingly, there's little or no net issuance in the CLO market. There's issues coming all the time. These are repackagings of bank loans. They're coming fast and furious, but it's all just it's all refinancing. So you see the gross issuance, using this exhibit from Morgan Stanley, the gross issuance is pretty robust, up at about 600 billion. But you'll notice that the net issuance, because it's being used to call existing deals, is actually the first negative year in at least 11 years. So this is an incredibly strong technical factor for this market. And I think that's been supportive of the prices and something we've been expecting. Real quickly, what you don't want to do based upon valuation relative to history, you don't want to go from BBB to BB. You get very little in terms of incremental. The gray shaded area, you want as much gray shading as possible to incentivize you from downgrading from BBB to BB, but there's very little there right now. The lowest ever was 45 basis points, and that was a horrible time to have been downgrading. And right now it's 69 basis points, which is not very far away. It's not as bad, but there's very few instances that this has been as tight. And this far into a yield curve inversion and economic cycle and rising, gradually rising unemployment rate that you don't want to be downgrading for no reward. However, if you go from triple B, the highest category of high yield, into double B, the highest category of high yield, you do get a very high pickup. But there's a reason for that. And the reason is that people know that defaults are going to start coming in the lower reaches of the high yield bond market. They don't look terrible now, but they're definitely protecting themselves because you're among the higher. If you did this on a moving average basis, which is on there, you can see it's at one of the higher ones over the past decade. I talked about Europe, how I liked starting to invest in Europe way back in late 2021. It hasn't really worked versus the S&P 500, but it hasn't really been that bad either. It's been almost a push over that in front of me now. Okay, so here's one that is just nonstop, and that's the S&P outperforming emerging markets. It's back at it again. We haven't gone to a new high on the S&P divided by the emerging market futures, but it's awfully close. But this is a trend you absolutely don't want to fight until the trend breaks. So we've not been really interested or active in emerging market versus the S&P. So with that, I'll wrap it up. I've gone a little long, but I went through that whole 1968 thing. Do look into that Atlantic website. So Andrew, I'm going to turn it over to you to cover some of the facts of the total return bond fund.